Now let us discuss exceptions to method of accounting. First, I am going to start with section 45 1A, damage or destruction of capital asset. I will take one example. On 6th June 2016, I purchased one building. On 4th April 2022, building was caught in fire. So whenever building was caught in fire, building got destroyed. So on a safer side, I have taken fire insurance policy for my building. I paid fire insurance premium on a timely basis. So whenever I took fire insurance policy, obviously compensation will be paid, right? So on 6th August 2024, compensation paid to me of rupees, let's say I purchased it for 20 lakhs. On 6th August 24, I got compensation of 45 lakhs. This is the scenario. In previous class, I have told you even extinguishment of capital asset is also considered as transfer. So whatever the destruction of capital asset is there, because of fire, building got destroyed. Even destruction of capital asset is also considered as transfer, and whatever the compensation received from insurance company is there, on that compensation capital gains are required to be calculated. What is the general rule? General rule is capital gains are taxable on accrual basis. Accrual means what? Year of transfer. So what is the transfer here? Even damage or destruction of capital asset, that is also considered as transfer, right? So 4th April 22, that means 22-23. Previous year 22-23 is year of transfer. Generally, capital gains are required to be taxable on year of transfer. But this is a special case. In this special case, capital gains are not taxable in the year of transfer, but capital gains are taxable in the year in which compensation is received from insurance company. When compensation is received from insurance company? 6th August 24. That means this falls under the previous year 24-25. So this is the year of receipt of compensation. So when capital gains are taxable, capital gains are not taxable in the year of transfer. Capital gains are taxable in the year in which compensation is received. That's why this is an exception to method of accounting. Generally, as per method of accounting, capital gains are taxable on accrual basis. But in this case, capital gains are not taxable on accrual basis. They are taxable in the year in which compensation is received. Okay. Now, this is a special case, damage or destruction of capital asset. In this special case, capital gains are not taxable in the year of transfer, but they are taxable in the year in which compensation is received from insurance company. And in this special case, period of holding will be calculated from date of purchase up to the date prior to the date of destruction. That means in this case, period of holding will be calculated from 6th June 2016 to 3rd April 2022. Are you able to understand? Date of purchase up to the date prior to the date of destruction. And building was purchased in 2016. Destruction happened in 2022. So obviously period of holding is greater than 36 months. It will greater than 24 months. Land will fall under category 2. Immovable property will fall under category 2. So obviously period of holding is greater than 24 months. If period of holding is greater than 24 months, it is classified as long-term capital asset. For long-term capital asset, you can claim indexation benefit, right? So in this case, indexation will be calculated from year of purchase. What is year of purchase? 16-17. So in this case, indexation will be calculated from previous year 16-17 to previous year 22-23. Another important point, whatever the compensation received from government is, received from insurance company is there, that is to be taken as full value of consideration. Is it clear? So as per section 45(1)(a), damage or destruction of capital asset, year of taxability is not year of transfer. Year of taxability is year in which compensation is received from insurance company. Whatever the compensation received, that is to be taken as full value of consideration. Period of holding will be calculated from date of purchase up to the date prior to the date of destruction. Indexation will be calculated from year of purchase up to the year of destruction. Is it clear? So you can see year of transfer, previous year in which asset was damaged or destructed. Year of chargeability, year of taxability is year in which compensation is received. That's why it is an exception to method of accounting. And what is to be taken as full value of consideration? Whatever the money received from insurance company is there, that is to be taken as full value of consideration. If insurance company, instead of giving cash, it gave new building, then fair market value of the building on the date of issuance, that is to be taken as full value of consideration. So if asset is received from insurance company, fair market value of asset received on the date of receipt is to be taken as full value of consideration. Period of holding will be calculated from date of purchase up to the date prior to the date of destruction. Indexation benefit is available up to the year of destruction. Please remember, section 45(1)(a) gets attracted only if two conditions are satisfied. First condition, there should be damage or destruction of capital asset. Second condition, insurance compensation should be received. That means what? My building got destroyed. I did not get insurance compensation. Now capital gains will not get attracted under section 45(1)(a). Capital gains will get attracted. Capital gains are required to be calculated only if compensation is received from insurance company. If compensation is not received means then capital gains are not required to be calculated. That means section 45(1)(a) gets attracted only if insurance compensation is received from insurance company. Are you able to understand? There should be damage or destruction of capital asset and insurance compensation should be received from insurance company. If these two conditions are satisfied, then section 45(1)(a) gets attracted. Conjunction is and. Next, only on destruction of capital asset 45(1)(a) gets attracted. Are you able to understand? If compensation was received in respect of destroyed plant and machinery, same will be taxed in the hands of recipient under section 45(1)(a). If compensation has been received on account of destroyed stock, whether stock is a capital asset, stock is not a capital asset. That's why with regard to stock, if any compensation is received, 45(1)(a) will not get attracted, PGBP head gets attracted. So on account of damage of stock, if any insurance compensation is received, that insurance compensation is taxable under the head PGBP. That insurance compensation will be credited to P&L account. Only on destruction of capital asset, if any compensation is received, then only capital gains gets attracted under section 45(1)(a). If stock in trade gets destroyed, 45(1)(a) will not get attracted because stock in trade is not a capital asset. Next, let us discuss conversion of capital asset into stock in trade. I will tell one example. Through this, you will be able to understand. On 6th June 2016, I purchased a land. As a chartered accountant, if I purchase any land, then that land will be a capital asset in my hands. I purchased it for rupees 16 lakhs. On 18th May 2022, I started a real estate business. In that real estate business, I transferred this land. That means what? In real estate business, I am taking this land. That means I am converting my capital asset into stock in trade. On which date I converted? On 18th May 22. On this day, on the date of conversion, fair market value of land is 47 lakhs. Next, on 2nd August 2023, what I did? I sold land as part of business for rupees 60 lakhs. Let's say on 2nd August 2024, not 2023. I sold land as part of business for 60 lakhs. Do you agree with me? For this period, land is capital asset, and for this period, land is stock in trade. Do you agree? This is a special case. In this case, generally capital gains are taxable in the year of transfer. But whenever you convert capital asset into stock in trade, in that case, capital gains are not taxable in the year of transfer, but capital gains are taxable in the year in which stock in trade is sold. In the previous class, I told even conversion of capital asset into stock in trade is also considered as transfer, and capital gains are required to be calculated. So what is year of transfer? Year of transfer is year of conversion. When conversion happened in 22-23, previous year 22-23 is year of conversion. Next, 2nd August 2024, it is previous year 24-25. When stock in trade is sold in 24-25, stock in trade is sold. So year in which stock in trade is sold is 24-25. Generally capital gains are taxable in the year of transfer, but this is a special case. Capital gains are not taxable in the year of transfer, but they are taxable in the year in which stock in trade is sold. That's why this is an exception to method of accounting. In this case, in this exception to method of accounting, whatever the fair market value on the date of conversion is there, that is to be taken as full value of consideration. Period of holding will be calculated from date of purchase up to the date prior to the date of conversion. That means period of holding will be calculated from 6th June 2016 to 17th May 2022. Next, indexation. Indexation will be calculated from year of purchase. When it was purchased 16-17. Indexation will be calculated from 16-17 to previous year 22-23. Are you able to understand? So, shall we calculate capital gains? Obviously, land is held for more than 24 months. Period of holding is greater than 24 months. It is classified as long-term capital asset. So, what is the year of transfer? Year of transfer is 22-23. So, calculation of long-term capital gain or long-term capital loss for previous year 22-23. Intern assessment year 23-24. What is to be taken as full value of consideration? 47 lakhs is to be taken as full value of consideration. From this, what will we reduce? We will reduce indexed cost of acquisition. What is the formula? Cost of acquisition into cost inflation index in the year of transfer divided by cost inflation index in the year of purchase. So what is year of transfer? Year of transfer is 22-23, year of purchase is 16-17. So 22-23 index number divided by 16-17 index number. So how much is cost of acquisition? It was purchased for 16 lakhs, right? 16 lakhs into what are index numbers? Yeah, we need index number for 16-17, 264, 22-23, 331. So 331 divided by 264, how much? 20 lakh 6,060. So how much is long-term capital gain? Long-term capital gain is 26 lakh 93,940. Now did you understand how to calculate capital gains in case of conversion of capital asset into stock in trade? So this story is over. We have calculated capital gains. Now it is sold in the business, right? We need to calculate PGBP income. So calculation of PGBP income. 1 second here. Year of transfer is 22-23, but capital gains are required to be calculated for 24-25. So here it is not 22-23, it is 24-25. Capital gains are required to be calculated for 24-25. Calculation of PGBP income. Even PGBP income will also be calculated for previous year 24-25. Now, at what price it is sold in the business? It is sold in the business for 60 lakhs. So sale value. How much is sale value of land? 60 lakhs. And whatever the fair market value on the date of conversion is there, that is to be taken as purchase cost. This is to be taken as purchase cost for calculation of PGBP income. So how much is purchase cost? Purchase cost is 47 lakhs. How much is PGBP income here? PGBP income is 13 lakhs. Now are you able to understand? That means in case of conversion of capital asset into stock in trade, capital gains and business income both are calculated in the year in which stock in trade is sold. Is it clear? Good. And whatever the fair market value on the date of conversion is there, that is to be taken as purchase cost for the purpose of business. You can see here taxable event conversion of capital asset into stock in trade. Year of transfer, year of conversion, year of taxability in which stock in trade is sold. That's why this is an exception to method of accounting. Consideration, fair market value on the date of conversion. Period of holding from date of acquisition up to the date prior to the date of conversion. Indexation facility available. As it is available, it will be calculated from year of purchase up to the year of conversion. Both capital gains and business income are taxable in the year in which stock in trade is sold. Fair market value on the date of conversion is to be taken as cost of acquisition for computation of PGBP income. See, if personal effect is converted into stock in trade, then 45(2) will not apply. My watch is there. Watch is a personal effect. It is a movable asset. It is used for my personal purpose and it is not excluded from definition of personal effect. After 4 months, I started watches business. In that watches business, I kept my watch also. That means personal effect I am converting into stock in trade. If I convert personal effect into stock in trade, 45(2) is not applicable. 45(2) is applicable only if capital asset is converted into stock in trade. Are you able to understand? Next, let us discuss compulsory acquisition of capital asset. Whenever capital asset is compulsorily acquired by government, then government will pay compensation, right? On receipt of such compensation, capital gains are required to be calculated. In the previous class also we have seen when I am discussing definition of transfer. Transfer includes compulsory acquisition of capital asset. So whenever capital asset is compulsorily acquired by government, even the transaction is also considered as transfer and capital gains are required to be calculated. Is it clear? Okay, I will discuss one example, you will understand. On 13th September 2012, I purchased a land for rupees 30 lakhs. On 9th December 2022, government compulsorily acquired land. See, even compulsory acquisition of a capital asset is considered as transfer, right? So capital gains are required to be calculated. On 24th April 2024, government paid compensation of rupees 65 lakhs. In this scenario, generally here in this case, what is the year of transfer? Year of transfer is year of compulsory acquisition. So previous year 22-23, this we can call as year of transfer. Generally, capital gains are taxable in the year of transfer, but this is an exception. In this case, in case of compulsory acquisition of capital asset, capital gains are not taxable in the year of transfer, but they are taxable in the year in which compensation is received from government. So, when compensation is received, year of receipt of compensation. Compensation is received in previous year 24-25. So previous year 24-25 we call as year of taxability. That's why this is an exception to method of accounting. Capital gains are not taxable in the year of transfer, but they are taxable in the year in which compensation is received from government. This is a special case. In this special case, period of holding will be calculated from date of purchase up to the date prior to the date of compulsory acquisition. When compulsory acquisition happened 9th December. So we will calculate period of holding up to 8th December. Period of holding will be calculated from 13th September 2012 to 8th December 2022. In this case, indexation will be calculated from year of purchase up to the year of compulsory acquisition. What is year of purchase? Year of purchase is 12-13. So from 12-13 to 22-23 we will calculate indexation, and whatever the compensation received from government is there, that is to be taken as full value of consideration. Is it clear? So on compulsory acquisition of capital asset, capital gains are taxable not in the year of compulsory acquisition, but they are taxable in the year in which compensation is received. Period of holding will be calculated from date of purchase up to the date prior to the date of compulsory acquisition, and whatever the compensation received from government is there, that is to be taken as full value of consideration. Indexation will be calculated from year of purchase up to the year of compulsory acquisition. So this is the concept. Now let's say SSE is not happy with 65 lakhs compensation. SSE filed a case in the court for getting enhanced compensation. Court sanctioned enhanced compensation. In 28-29, in previous year 28-29, court gave enhanced compensation of 10 lakhs. That means along with 65 lakhs, additionally 10 lakhs. That means total 75 lakhs. So when enhanced compensation 10 lakhs given, it is given in 28-29, correct? So enhanced compensation is taxable on receipt basis. The year on which enhanced compensation is received, in that year enhanced compensation is taxable. Are you able to understand? Enhanced compensation is taxable in the year in which enhanced compensation is received. But when you are calculating capital gains on enhanced compensation, you cannot claim cost of acquisition as deduction, you cannot claim cost of improvement as deduction. The reason is, when you are calculating original capital gains, cost of acquisition and cost of improvement is allowed as deduction, right? That's why, see, when you are calculating in 24-25 year of taxability, you are calculating original capital gains. When you are calculating original capital gains, you are already claiming cost of acquisition and cost of improvement. So again, in the year in which enhanced compensation is received, second time cost of acquisition is not allowed as deduction, second time cost of improvement is not allowed as deduction. But to get that enhanced compensation, if any legal fees is paid, see, I filed case in the court for getting enhanced compensation. So my lawyer went to court, he argued on behalf of me and got 10 lakhs compensation. I paid 1,50,000 lawyer fees. Whatever the legal fees I paid to lawyer to get that enhanced compensation, that legal fees is allowed as deduction from enhanced compensation. Is it clear? Now, enhanced compensation was given after 4 years in 2028-29. So along with enhanced compensation, court also ordered for interest on enhanced compensation 70,000 rupees. How much is interest on enhanced compensation? 70,000 rupees. This is taxable under the head income from other sources. So if any interest on enhanced compensation is received, that is taxable under the head income from other sources. You can see interest on enhanced compensation taxable under the head other sources. For example, I will give another point. I will tell another point. After this guy filed a case in the court reduced the compensation. That means what? Compensation given is 65 lakhs. Court reduced compensation to 58 lakhs. That means if compensation is further reduced by the court, the year in which compensation is reduced by the court, in that year capital gains are again have to be recalculated, and whatever the extra capital gain that is paid is there, that will be refunded to the SSC. So the year in which compensation is reduced by the court, in that year you have to recompute the capital gains, and whatever the extra capital gain that is paid earlier is there, that will be given back by the income tax department in the form of refund. Is it clear? So in case of compulsory acquisition of capital asset, year of transfer is year of compulsory acquisition. Year of taxability is year in which compensation is received. If compensation is received in installments, total capital gains are taxable in the year in which first installment is received. And what is to be taken as full value of consideration? Whatever the compensation received from government is there, that is to be taken as full value of consideration. Period of holding will be calculated from date of acquisition up to the date prior to the date of compulsory acquisition. Indexation will be calculated up to the year of compulsory acquisition. If enhanced compensation is received, it is taxable in the year in which it is received. Interest on enhanced compensation taxable under other sources. Cost of acquisition and cost of improvement you cannot claim as deduction from enhanced compensation. Only legal expenses you can claim as deduction. Is it clear? Good. Now let us start discussing section 50B, slump sale. See, if business as a whole is sold for lump sum consideration without ascertaining individual assets and liabilities, then that concept we call as slump sale. For example, Mr. A is running a medical shop. He wanted to sell medical shop. He has two options. First option, he can sell assets individually. He can sell refrigerator separately, he can sell air conditioner separately, he can sell stock of medicine separately. That is option 1. Second option, Mr. A sold medical shop as a whole. That means what? From tomorrow onwards, Mr. B will come to medical shop and he will sit in the medical shop, and everything that is there in the medical shop belongs to Mr. B. That means if business as a whole or division as a whole or undertaking as a whole, if it is sold to another person, then that concept we call as slump sale. So Mr. A, he is not calculating individually for AC this much amount, for refrigerator this much amount, for medicines this much amount. He is not calculating individually. Collectively he is saying some lump sum consideration. So if business as a whole is sold for some lump sum consideration, then that concept of sale we call as slump sale. So in case of slump sale, generally in simple terms, can we write capital gain like this? Capital gain is equal to full value of consideration minus cost of acquisition. Can we write like this? Yes. In case of slump sale, full value of consideration is equal to fair market value of capital assets transferred or lump sum consideration received. Whatever the lump sum consideration received is there, that whichever is higher is to be taken as full value of consideration. Next, cost of acquisition means nothing but net worth. What is to be taken as cost of acquisition? If it is single asset, purchase cost you will take as cost of acquisition. In this case, in slump sale, you are selling business as a whole. So cost of acquisition is equal to net worth. What is formula for net worth? Formula for net worth is equal to assets minus liabilities. Now, assets. If asset is depreciable asset, you will consider written down value. Written down value as on the beginning of the previous year, as on 1st April of previous year in which slump sale happened. If asset is non-depreciable asset, for example land, then when you are calculating the value of assets, you will consider book value. If the asset is self-generated asset, then you will consider value of that asset as nil. Okay, you can see here, asset is self-generated, you will consider the value as nil. If the asset is allowed as deduction under section 35 AD, specified business, Then for that asset also you have to take value as nil. So you have to add value of all these assets. From value of all these assets, you have to reduce value of liabilities. Thereby you will arrive at the net worth. So in case of depreciable assets, you will consider written down value as on the beginning of previous year. In case of non-depreciable assets, you will consider book value. In case of self-generated assets, you will consider value as 0. For 35 AD assets also, you will consider value as 0 because already in the year of purchase, for 35 AD assets, 100% deduction is allowed. As 100% expenditure is already claimed as reduction, again in calculation of net worth, it will be considered as 0 and no deduction is allowed. So this is how you have to calculate the value of assets. From value of assets, you need to reduce value of liabilities. Thereby you will arrive at net worth. One important point here. If any revaluation is done, revaluation amounts you should not consider. Revaluation figures are to be ignored in calculation of net worth. Next. Sir, here individual assets are not transferred. Business as a whole is transferred. So you will calculate period of holding for business. Are you able to understand? So you will not calculate period of holding of each asset. You will calculate period of holding of business. So period of holding is equal to date of commencement of business up to the date prior to the date of transfer. Okay. Before 23rd July 2024, if period of holding of business is greater than 36 months, then long-term capital gains will arise. If period of holding of business is less than 36 months, short-term capital gain will arise. On or after 23rd July 2024, if period of holding of business is greater than 24 months, long-term capital gains will arise. On or after 23rd July 2024, if period of holding of business is less than 24 months, then short-term capital gains will arise. This is the concept of slump sale. Very simple. Full value of consideration is equal to fair market value of capital assets transferred or lump sum consideration, whichever is higher. Cost of acquisition is net worth, value of assets minus value of liabilities. And as it is as business as a whole is transferred, we will calculate period of holding for business. Period of holding is equal to date of commencement of business up to the date prior to the date of transfer. Please do one problem on slump sale. You will understand this topic. Next, let us discuss section 50C. When section 50C is applicable on transfer of immovable property. So in the question, if you see building is transferred or land is transferred or house is transferred, immediately you should remember section 50C is applicable. Are you able to understand? So on transfer of immovable property, section 50C gets attracted. Sir, what if section 50C gets attracted? So if section 50C gets attracted, provision is if stamp duty value is greater than 110% of actual consideration, 110% of actual consideration, then full value of consideration is equal to stamp duty value. If stamp duty value is less than or equal to 110% of actual consideration, then full value of consideration is equal to actual consideration. I will tell one example so you will understand it better. Stamp duty value, actual consideration, 110% of actual consideration, full value of consideration. Let's say stamp duty value is 215 lakhs. Actual consideration is 200 lakhs. How much is 110% of actual consideration? 110% means what? 200 lakhs plus 10%. How much it is? 220 lakhs. In this scenario, what is the equation? Stamp duty value is less than 110% of actual consideration. So in this case, full value of consideration is equal to actual consideration, which is equal to 200 lakhs. Is it clear? Second example. Stamp duty value is 340 lakhs. Actual consideration is 300 lakhs. Now how much is 110% of actual consideration? 300 lakhs plus 10%, which is 330 lakhs. So here what is the equation? Stamp duty value is greater than 110% of actual consideration. 340 lakhs is greater than 330 lakhs. So in this case, full value of consideration is equal to stamp duty value is equal to 340 lakhs. Are you able to understand? So if stamp duty up to 10%, if there is any difference, he will accept, but if difference is more than 10%, officer will not accept. That's why if stamp duty value is greater than 110% of actual consideration, then whatever the stamp duty value is there, the stamp duty value you have to take as full value of consideration. Is it clear? If stamp duty value is less than or equal to 110% of actual consideration, in that case, whatever the actual consideration is there, such actual consideration you have to take as full value of consideration. I will tell another example. Stamp duty value is 440 lakhs. Actual consideration is 400 lakhs. What is the equation? 400 lakhs plus 10%. How much is 110% of actual consideration? 110% of actual consideration is also 440 lakhs. In this case, stamp duty value is exactly equal to 110% of actual consideration. So in this case, full value of consideration is equal to actual consideration is equal to 400 lakhs. Now did you understand the provision? Very simple. First, in case of transfer of immovable property, 50C gets attracted. For movable properties, you need not check 50C. 50C enters only on transfer of immovable asset. What is the provision? If stamp duty value is greater than 110% of actual consideration, stamp duty value is to be taken as full value of consideration. If stamp duty value is less than or equal to 110% of actual consideration, then actual consideration is to be taken as full value of consideration. Is it clear? Another point. Let's say date of agreement. Date of agreement is 5th November 2022. Date of registration is 2nd February 2023. In this case, agreement date is different, registration date is different. On date of agreement, stamp duty value is 80 lakhs. On date of registration, stamp duty value is 95 lakhs. That means date of agreement is on one date, date of registration is on another date, and in between these two dates, stamp duty value got changed. In this scenario, sir, which stamp duty value I have to consider? So very simple. If there is a separate date of agreement and separate date of registration, and there are separate stamp duty values for date of agreement and date of registration, then there are three conditions. How many conditions? Three conditions. If all these three conditions are satisfied, conjunction is and if all these three conditions are satisfied, then you will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then you will consider stamp duty value on the date of registration. Is it clear? What are the three conditions? Full or part of the consideration must be received. When it should be received? It should be received on or before the date of agreement. How it should be received? It should be received by any mode other than cash. If all these three conditions are satisfied, that means what? There is date of agreement, right? There is date of agreement. Before date of agreement only, full or part of consideration must be received. It should be received before date of agreement. And how it should be received? It should be received by way of bank transaction. Any mode other than cash means what? By way of bank transaction. So if all these three conditions are satisfied, then we will consider stamp duty value on the date of agreement. Is it clear? If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Is it clear? So if date of agreement is on separate date and date of registration is on another date, and in between these two dates, if there is change in stamp duty value, we have to check three conditions. If all the three conditions are satisfied, then we will consider stamp duty value on the date of agreement. If any one of the conditions are not satisfied, then we will consider stamp duty value on the date of registration. Is it clear? So full or part of the consideration must be received. It must be received on or before the date of agreement. It should be received by bank transaction, any mode other than cash. All the three conditions satisfied, we will take stamp duty value on the date of agreement. Any one of the conditions not satisfied, we will take stamp duty value on the date of registration. Very important provision, section 50C. Quite often it is being asked in the examination. So please listen carefully and please apply properly in the question. Okay. Next. Sometimes SSC feels that stamp duty value is greater than fair market value. For example, a sold building. Actual consideration is 90 lakhs. However, stamp duty value is 160 lakhs. So in this case, stamp duty value 160 lakhs is greater than, one second. Stamp duty value 160 lakhs, actual consideration is 90 lakhs. Fair market value is 130 lakhs. What do you mean by fair market value? SSC is arguing with income tax officer. Sir, I made transaction for 90 lakh rupees. In that area, if you want to sell that building, beyond 130 lakhs, no person will buy. That means maximum amount that can be spent for that building is 130 lakhs. Right now, the market value of that building is 130 lakhs. So SSC is asking income tax officer, sir, I don't know how stamp duty value is 160 lakhs. In that area, no person will purchase that building for more than 130 lakhs. So SSC is feeling that stamp duty value is greater than fair market value. How much is fair market value here? Fair market value is 130 lakhs. So SSC is feeling that stamp duty value is so greater than fair market value. So in this case, SSC can approach income tax officer for recomputation of stamp duty value. Are you able to understand? Now, in this case, SSC is having two options. When SSC feels that stamp duty value is far more than fair market value, then SSC will be having two options. Option 1, SSC can file case in court or appellate authority. File case in court or appellate authority. If he files case in court or appellate authority, full value of consideration is equal to value determined by court. If court increases the value, increased value will be considered as full value of consideration. If court decreases the value, decreased value will be considered as full value of consideration. So whenever SSC feels that stamp duty value is greater than fair market value, option 1, he can file case in court or appellate authority. If he files case in court or appellate authority, full value of consideration is equal to value determined by court or appellate authority. Option 2, like SSC can request income tax officer to refer the case to valuation officer for the purpose of valuation. Then income tax officer will refer the case to valuation officer if SSC do not file case in any court or appellate authority. So option 2 is request ITO, request income tax officer to refer case to valuation officer. Then valuation officer will determine the fair market value of the property. Two options will come. If value determined by valuation officer is greater than stamp duty value, in this case, full value of consideration is equal to stamp duty value. If value determined by valuation officer is less than stamp duty value, in this case, full value of consideration is equal to value determined by valuation officer. I will tell example. Stamp duty value is 160 lakhs, right? Value determined by valuation officer is 180 lakhs, which is greater than 160 lakhs. So in this case, full value of consideration is equal to 160 lakhs. Now, second, option 2. Value determined by valuation officer is less than stamp duty value. Let's say valuation officer has calculated fair market value of the property. Fair market value of property is only 140 lakhs. So value determined by valuation officer is 140 lakhs. Stamp duty value is 160 lakhs. So in this case, full value of consideration is equal to 140 lakhs. Are you able to understand the example? So this is all about section 50C. Very, very important. Please go through the concept very clearly. Next, section 50C. Whenever unlisted company shares are transferred, In case of transfer of unlisted company shares, if actual consideration is less than fair market value, then fair market value is to be taken as full value of consideration. Let's say there is a company with the name ABC Limited. This is not listed in stock exchange. If company is not listed in any stock exchange, we call that company as unlisted company. I am selling shares of ABC Limited. Actual consideration is 80 lakhs, but fair market value of shares is 110 lakhs. So whenever I sell shares, I am required to calculate capital gains, right? Here, let us compare actual consideration with fair market value. Actual consideration is 80 lakhs, fair market value is 110 lakhs. Actual consideration is less than fair market value. So in this case, full value of consideration is equal to fair market value is equal to 110 lakhs. Is it clear? So whenever unlisted company shares are transferred, then we have to compare actual consideration with fair market value. If actual consideration is less than fair market value is to be taken as full value of consideration. Is it clear? Next, forfeiture of advance. Forfeiture of advance means what? Nothing but cancellation of advance. There are two persons, A, B. A wanted to sell building to B. So B gave non-refundable advance of rupees 5 lakhs. Let's say sale consideration is equal to 60 lakhs. So B told balance 55 lakhs will be paid in 1 month. Will be paid in 1 month. After 1 month, B could not pay the amount. After 1 month, B did not pay amount. If B did not pay amount, obviously the agreement will get cancelled and A did not give 5 lakh rupees to B. A did not give 5 lakh rupees to B. Entire transaction got cancelled and A got 5 lakh rupees. Whatever the advance he took 5 lakh rupees, that is not refunded. Advance amount is cancelled by Mr. A. So whatever the advance amount that is cancelled is there, that we call as forfeiture of advance. Many times with regard to transfer of capital asset, advance will be taken by the seller and that advance will be taken on a non-refundable basis. If buyer pays the consideration, well and good. If buyer do not pay the consideration, then whatever the advance that is taken is there, it will not be given back. That will not be refundable. So whatever the non-refundable advance amount 5 lakh rupees is there, it is income to Mr. A, right? That we call as forfeiture of advance. If advance amount is cancelled and it is not given back, then that concept we call as forfeiture of advance. Is it clear? Here the rule is, if advance is forfeited, before 1st April 2014. If advance is forfeited before 1st April 2014, not 4, then what is the tax treatment? Advance forfeited is to be reduced from cost of acquisition on transfer of capital asset, on subsequent transfer of capital asset. For example, in 2011, advance forfeited is equal to 2 lakhs. Advance forfeited is equal to 2 lakhs. Building purchased. Actually, this building was purchased in 2007 for rupees 10 lakhs. At what price building was purchased in 2007? 10 lakhs. In 2011, he wanted to sell the building. He received advance of 2 lakhs. but buyer did not pay total consideration. So seller cancelled the agreement and advance was forfeited. How much amount of advance was forfeited? 2 lakh rupees. In 2015, building was sold. Building was sold for rupees 20 lakhs. When building was sold for 20 lakhs, what is full value of consideration? Full value of consideration is equal to 20 lakhs less indexed cost of acquisition. Before calculating indexation, how much is cost of acquisition? It was purchased for 10 lakhs, right? But 10 lakhs is not allowed as deduction. From this 10 lakhs, you have to reduce this 2 lakhs because 2 lakhs is income, right? Advance forfeited. That is to be reduced. So cost of acquisition is equal to 8 lakhs and this 8 lakhs is to be indexed. Are you able to understand? So if advance amount is forfeited before 1st April 2014, in the year of forfeiture, when advance was forfeited? 2011. In 2011, tax will not be required to be paid. So tax liability will not get attracted in 2011, but tax liability will get attracted in the year in which asset was subsequently transferred. When asset was subsequently transferred? Asset was subsequently transferred in 2015. In 2015, tax is getting attracted. How tax is getting attracted? Directly on 2 lakhs, tax is not levied, but 2 lakhs amount will be reduced from cost of acquisition. Cost of acquisition 10 lakhs. From 10 lakhs, 2 lakhs amount is reduced. Are you able to understand? Only 8 lakhs will be allowed as cost of acquisition, and that 8 lakhs will be indexed, and indexed cost of acquisition is allowed as deduction. So simple, advance amount forfeited before 1st April 2014. In the year of forfeiture of advance, nothing is taxable. But in the year in which asset is subsequently transferred, advance amount forfeited will be reduced from cost of acquisition. Is it clear? This is the tax treatment. If advance amount is forfeited on or after 1st April 2014, on or after 1st April 2014, then advance forfeited is taxable under other sources in the year of forfeiture. So the year in which advance is cancelled, in that year only advance forfeited is taxable under the head other sources. For example, 2025. Today, I entered into agreement for the purpose of sale of my building. I received advance. I gave 1 week time. If within 1 week he pays total consideration, fine. If he does not pay total consideration, advance of 1 lakh rupees that is received by me, that will not be refunded back. So whatever the advance that is not refunded by me after 1 week, that advance amount forfeited of rupees 1 lakh is taxable to me under the head other sources in previous year 24-25 only. Are you able to understand? So on or after 1st April 2014, if any advance amount is forfeited, such forfeiture of advance is taxable under the head other sources in the year of forfeiture. Are you able to understand? So this is the concept. Now let us discuss exemptions. First, let us discuss exemption under section 54. What is the combination for exemption under section 54? Combination is residential house property to residential house property. That means when you are selling residential house property, whatever the amount that is received is there, gross capital gain. If the gross capital gain amount is again reinvested in new residential house property, then whatever the amount that is reinvested, that is allowed as exemption under section 54. So combination is residential house property to residential house property. Careful, many people claim exemption blindly. The moment they see amount is reinvested in new residential house property, they will claim exemption blindly without checking who is the SSC. The reason is only for individual or HUF, exemption under section 54 is available. That means let's say company is selling a building and company reinvested that that money received in a new building. Can company claim exemption under 54? No, only individual or HUF when they are selling residential house property. If the capital gain received is again reinvested in new residential house property, then only individual or HUF can claim exemption. So only individual or HUF is eligible for exemption under section 54. What is the nature of capital asset transferred? Nature of capital asset transferred should be long-term capital asset. That means whatever the residential house property that is transferred is there, that should be a long-term capital asset. Then only exemption under section 54 is available. Otherwise, exemption under section 54 is not available. Is it clear? Let's say I sold one flat. I held that flat for only 8 months. If I held that flat for only 8 months, it is a short-term capital asset. On sale of that flat, I got capital gains. If that capital gain amount I invested in purchase of new building, that amount is not eligible for exemption, because whatever the capital asset that I am transferring is there, it is not a long-term capital asset. Is it clear? Only if capital asset transferred is long-term capital asset, then only exemption under section 54 is available. So capital asset required to be transferred is residential house property. So C, such residential house property transferred should be taxable under the head house property. Office building I am transferring. Whether office building is taxable under the head house property? No, office building is taxable under the head PGBP. On sale of office building, exemption under section 54 is not available. Only on sale of residential house property, exemption under section 54 is available. Next. Amount to be reinvested. What is the amount that is required to be reinvested? You remember the format, right? First we will calculate full value of consideration, then we will reduce the transfer expenses, then we will arrive at net consideration, then from that net consideration we will reduce cost of acquisition, thereby we will arrive at capital gains, gross capital gains. So what is the amount that is required to be invested? Amount required to be reinvested is not full value of consideration. Amount required to be reinvested is not net consideration. Amount required to be reinvested is gross capital gains. So like I sold a building for 1 or 2 lakhs. 2 lakhs are sales commission. Net consideration is 100 lakhs. Let's say cost of acquisition of building is 32 lakhs. Now how much are capital gain? Capital gain are 68 lakhs. How much amount I have to reinvest? I have to reinvest 68 lakhs, not 100 lakhs. So what is the amount required to be reinvested? Amount required to be reinvested is gross capital gains. Is it clear? Where reinvestment should be made? I sold residential house property, I got capital gain. Where this capital gain I have to reinvest? I have to reinvest this capital gain in new residential house property. Is it clear? What are the time limits for reinvestment? Date of transfer. From date of transfer 1 year before or 2 years after, I have to purchase a house property. Then whatever the amount spent for purchase of new residential house property is there, that is allowed as exemption. I am not willing to purchase house property. I wanted to construct house property on my own. Then from date of transfer within 3 years, I have to construct a new house property. Then only exemption is available. So exemption under section 54 is available when reinvestment is made in new residential house property. To make reinvestment also there are time limits. If new residential house property is purchased either 1 year before the transfer or 2 years after the date of transfer, exemption under section 54 is available. If new residential house property is constructed within 3 years, construction may start before, construction may commence before the date of transfer, but construction should be completed within 3 years from the date of transfer. Is it clear? Next, capital gains account scheme. Whether capital gains deposit scheme is available? Yes, available. I will explain about capital gains account scheme after 2 to 3 minutes. Wait. How much is the exemption that is allowed? Exemption is equal to gross capital gain or reinvestment or 10 crores, whichever is lower. That means maximum exemption allowed under section 54 is equal to 10 crores. Holding period of new capital asset, 3 years from the date of purchase or construction. What do you mean by this? Let's say after 1.5 years, I purchased new house property. Now this new residential house property is eligible for exemption under section 54, right? So from this date onwards, 3 years from the date of purchase or construction. For next 3 years, I should not sell the house property. That means what? Lock-in period. I am selling one residential house property, capital gain received. This capital gain is reinvested in new residential house property. Once I reinvest in new residential house property, from the date of purchase or construction, for the next 3 years, I should not sell the new residential house property. Is it clear? That's what. Holding period means lock-in period. The date on which a new house property is purchased. From that date onwards, for the next 3 years, new residential house property should not be transferred. If new residential house property is transferred within 3 years, then what is the consequence? Earlier exemption claimed shall be reduced from cost of acquisition of new capital asset transferred. Is it clear? I will give an example so you will understand better. 2008-9, I purchased one building. For rupees 10 lakhs. In 14-15, I sold the building for rupees 22 lakhs. So how much is full value of consideration? 22 lakhs. Less cost of acquisition. Cost of acquisition is 10 lakhs. But I can claim indexed cost of acquisition, right? Let's say indexed cost of acquisition is 14 lakhs. So how much is my capital gain? My capital gain is 8 lakhs. Gross capital gain is 8 lakhs. In 2014, I sold the building on 6th January 2015. I sold the building. On 18th March 2015, I purchased a new house property for rupees 13 lakh. Now I can claim exemption, right? Less exemption under section 54 is equal to gross capital gain or reinvestment or 10 crores, whichever is lower. Gross capital gain is 8 lakhs. Reinvestment is 13 lakhs or 10 crores. Whichever is lower means 8 lakhs. 8 lakhs is exempted. Net capital gain to me is 0. Now I purchased a new house on 18th March 2015, right? From 18th March 2015 onwards, for the next 3 years, I should not sell new house. Three years means 18th March 2016, 18th March 2017, 18th March 2018. Up to 18th March 2018, I should not sell the new residential house property. Sir, he is in need of money. He sold the house within 3 years only. On 27th August 2017. 27th August 2017 means what? Before 18th March 2018, right? So on 27th August 2017, sold new residential house property for rupees 28 lakhs. Now on sale of this house, I need to calculate full value of consideration, right? Full value of consideration 28 lakhs. From this, I have to claim cost of acquisition. How much is cost of acquisition? I purchased this building for 13 lakhs, correct? I purchased that building for 13 lakhs. But 13 lakhs is not allowed as cost of acquisition. whatever the exemption that I have claimed earlier. How much is the exemption that I have claimed earlier? 8 lakhs. So from 13 lakhs, 8 lakhs will be reduced and only 5 lakhs is allowed as cost of acquisition. If indexation benefit is available, then this 5 lakhs will be indexed and indexed cost of acquisition is allowed as deduction. Is it clear? So the date on which you purchase the new house property. When new house property was purchased 18th March 2015. From that date onwards, for the next 3 years, you should not sell the new house property. That means new house property will be locked for 3 years. Within these 3 years, if you transfer the new house property, means on transfer of such new house property, total cost of acquisition is not allowed as deduction. Whatever the exemption that is claimed earlier is there, that will be reduced from cost of acquisition and only net cost of acquisition is allowed as deduction. Is it clear? Total 13 lakhs is not allowed as deduction. Earlier exemption claimed 8 lakhs will be reduced from cost of acquisition and only net cost of acquisition will be allowed as deduction. If it is long-term capital asset, net cost of acquisition will be indexed. Is it clear? That is the scenario. Consequence is earlier exemption claimed will be reduced from cost of acquisition on transfer of new capital asset. Next, capital gains account scheme. Capital gains account scheme is available. I will explain this with one example. Today I sold the building. Let's say today is 26th February 2025. So on 26th February 2025, I sold my residential house property. I have time limit of 2 years to purchase new house property, or I have time limit of 3 years to construct a new house property, correct? So I can take 2 years to purchase new house and then I will claim exemption, or I can take 3 years to construct new house property and I can claim exemption. What is current previous year? 24-25. For 24-25, I have to pay tax and I have to file my income tax return, right? When I will pay tax in assessment year 25-26. Generally, what is the due date for filing ITR? 31st July of the assessment year or 31st October of the assessment year. That means on or before 31st July 2025 or on or before 31st October 2025, I have to file my income tax return. To file my income tax return, I have to pay tax. That means, see the order. I have to file ITR. To file ITR, I have to pay tax. To pay tax, I have to calculate tax. To calculate tax, I have to calculate total income. To calculate total income, I should know whether to claim exemption or not. See, I sold house property, right? Let's say on sale of house property, I got capital gains of 25 lakhs. Now, if I reinvest that amount in new house property, I can claim exemption. But to reinvest, I have time limit of 2 years or 3 years. But before that 2 years or 3 years only, there is due date for filing ITR. Now, at the time of due date of filing ITR, to calculate tax liability, I have to know whether to claim exemption or not. If I claim exemption, tax is lowered. If I do not claim exemption, tax will be more. So, before due date of filing ITR, I have to file ITR. To file ITR, I should calculate tax. To calculate tax, I have to know whether I can claim exemption or not. So, Income Tax Department came with one solution. Solution is, before due date for filing ITR, if you purchase house property, then exemption is allowed. Before you purchased house property, then exemption will be allowed. You constructed house property, then also exemption will be allowed. Before due date for filing ITR, you did not purchase, you did not construct. You wanted to take extra time of 2 years or 3 years. You wanted to take extra time of 2 years or 3 years. Then, before due date for filing ITR, whatever the amount that you wanted to reinvest is there. See here 25 lakhs is there. Out of 25 lakhs, you deposited 20 lakhs in capital gains account scheme, then 20 lakhs is allowed as exemption. Is it clear? You can claim 20 lakhs as exemption and only 5 lakhs capital gain will be taxable. That means before due date for filing ITR, you have to take a decision for reinvestment. Before due date for filing ITR, either you purchase new house property, claim exemption. You construct new house property, claim exemption. Not like that. You wanted to take extra time of 2 years for purchase or 3 years for construction. Then before due date for filing ITR, whatever the capital gain amount is there, out of that, whatever the amount that is deposited in capital gains account scheme is there, that amount is allowed as exemption. Is it clear? So due date is ITR due date. Before ITR due date only, you have to take the decision. Okay, whatever the amount that is deposited in capital gains account scheme before ITR due date is there, only that amount is allowed as exemption. For example, after ITR due date, you deposited 3 lakhs in capital gains account scheme. Is it allowed as exemption? That is not allowed as exemption. 23 lakhs is not allowed as exemption, only 20 lakhs is allowed as exemption. So before ITR due date, whatever the amount deposited in capital gains account scheme is there, that amount will be allowed as exemption. But whatever this 20 lakhs is there, this 20 lakhs should be used to purchase. 20 lakhs should be used for purchase of new house within 2 years, or 20 lakhs should be used for construction of new house within 3 years. For example, 3 years over. After 3 years, in capital gains account scheme, 18 lakhs used, 2 lakhs unused. After expiry of time limit of 2 years or 3 years, whatever the unused amount of 2 lakhs is there, that is taxable as capital gains. Taxable as capital gains after 3 years. Is it clear? Very simple. Before ITR due date, you have to take decision of reinvestment. Before ITR due date, either you purchase and claim exemption, construct and claim exemption, or deposit money in capital gains account scheme and claim exemption. Whatever the amount deposited in capital gains account scheme is there, that should be utilized within 2 years from the date of transfer for purchase, or within 3 years from the date of transfer for construction. If it is not utilized within 2 years or 3 years, whatever the unutilized amount is there, that is taxable after the expiry of 3 years or 2 years time limit. Is it clear? That's the discussion about section 54. You can see unutilized amount. Unutilized amount of capital gains account scheme. Capital gain relating to unutilized amount shall be taxable after the expiry of time limit. Is it clear? Good. Now, 54 is not over. One small point is there. Listen. When exemption of 54 is available, what is the combination? Combination is residential house property to residential house property. I sold one residential house property. Capital gains are 80 lakhs. With 80 lakhs, I purchased 2 houses. One residential house property worth 50 lakhs. Second residential house property worth 20 lakhs. Sir, can I claim both of these as exemption? That means 1:2 combination. On sale of one residential house property, reinvestment is made in 2 residential house properties. Sir, in 1:2 combination, can I claim exemption under section 54? Yes, you can claim exemption under section 54, but only once in a lifetime. That means only once in a lifetime in case of an SSC on transfer of single residential house property, reinvestment made in 2 house properties is allowed as exemption. So here you can claim exemption of 50 lakhs. 50 lakhs is allowed as exemption, 20 lakhs is also allowed as exemption. Is it clear? And 10 lakhs is taxable. Only once in a lifetime, investment in 2 residential house properties is allowed as exemption under section 54, subject to the condition gross capital gain should be less than 2 crores. Is it clear? So if gross capital gain is less than or equal to 2 crores, then reinvestment of 2 residential house properties in India. Another important point, I sold house in Delhi. I purchased a new house in Los Angeles, USA. New house in Los Angeles, USA, can I claim it as exemption? No, only if reinvestment is made in India, then only it is allowed as exemption. Okay. If long-term capital gain is greater than 2 crores, If long-term capital gain is greater than 2 crores, then reinvestment in only one residential house property is allowed as exemption. Is it clear? So this is all about section 54. Next, let us discuss section 54B. What is the combination for 54B? For 54B, combination is urban agricultural land to agricultural land. That means capital asset required to be transferred is urban agricultural land. Reinvestment should be made in agricultural land. Reinvestment can be made either in urban agricultural land or rural agricultural land. This is the combination for 54B. Even exemption under section 54B is available only for individual or HUF. That means other SSCs cannot claim exemption under 54B. Under section 54, under section 54B, exemption is available only for individual or HUF. Nature of capital asset transferred. That means urban agricultural land transferred can be either long-term capital asset or short-term capital asset. And capital asset required to be transferred is urban agricultural land. Where reinvestment should be made in agricultural land, and that reinvestment can be made either in urban agricultural land or in rural agricultural land. What is the amount that is required to be reinvested? Amount required to be reinvested is gross capital gain. How much time limit is available for reinvestment? Reinvestment should be made within 2 years from the date of transfer. Let's say today I sold urban agricultural land. What is today's date? 26th February 2025. From this date onwards, 2 years time limit is available. Within these 2 years, I have to purchase new agricultural land. 2 years means what? 25th February 2027. On or before 25th February 2027, I need to purchase new agricultural land. That new agricultural land can be either urban agricultural land or rural agricultural land. Is it clear? Another requirement, usage of asset. Whatever the urban agricultural land that is transferred is there. Here, when I am transferring urban agricultural land, I am transferring urban agricultural land on 26th February 2025. From 26th February 2025, you have to take last 2 years. For last 2 years, urban agricultural land should be used by SSC or his family members. SSC or his family members. Then only exemption is available, otherwise exemption is not available. In last 2 years, SSC can use the urban agricultural land either as a owner or as a tenant. Is it clear? So from date of transfer, in the last 2 years, preceding 2 years from the date of transfer, urban agricultural land should be used only for agricultural purposes either by SSC or his family members. Then only exemption under 54B is available, otherwise exemption under 54B is not available. Whether capital gains account scheme is available, as it is available. The reason is 2 years time limit is there for reinvestment. But before 31st July or 31st October, IT return is required to be filed. That's why before 31st July only, either he has to purchase new agricultural land or he should invest that money in capital gains account scheme, and whatever the money invested in capital gains account scheme is there, that amount he can claim as exemption under 54B. Amount of exemption is gross capital gain or reinvestment, whichever is lower. Holding period of new capital asset, nothing but lock-in period. That means when you invest in new agricultural land should not be transferred within 3 years from the date of purchase. Is it clear? Next. Consequence, if new agricultural land is transferred within the lock-in period, within 3 years, in such a case, earlier exemption claimed will be reduced from cost of acquisition on transfer of new agricultural land. We have seen in section 54, right? Same as section 54. Earlier exemption claimed with regard to reinvestment, that earlier exemption will be reduced from cost of acquisition on transfer of new agricultural land. Unutilized amount in capital gains account scheme. See, after 2 years, whatever the amount deposited in capital gains account scheme is there, if it is not fully utilized, whatever the unutilized amount is there, unutilized amount is required to be taxable after the expiry of time limit. Is it clear? That's all about section 54B. Next, let us discuss 54D. Any assessee can claim exemption under section 54D. Nature of capital asset transferred can be either short-term capital asset or long-term capital asset. Capital asset required to be transferred is land or building of an industrial undertaking. So what is the combination under 54D? Under 54D, combination is land or building of industrial undertaking to land or building of industrial undertaking. What do you mean by this? Asset required to be transferred is land or building of industrial undertaking. Reinvestment should be made in land or building of industrial undertaking. Then only exemption under section 54D is available. However, mode of transfer should be by way of compulsory acquisition. Is it clear? That means only by way of compulsory acquisition. If land or building of industrial undertaking is acquired, then only exemption under 54D is available. You sold land or building of industrial undertaking, you cannot claim exemption under 54D. Only if land or building of industrial undertaking is compulsorily acquired by government, that is also transfer, and capital gains are required to be calculated. In such case, if you do reinvestment in land or building of industrial undertaking, you can claim exemption. Is it clear? Next, usage of asset should be used for agricultural purposes for 2 years immediately preceding the date of, should be used for industrial undertaking for 2 years immediately preceding the date of transfer. Let's say on 7th March 2025, land or building was compulsorily acquired. Okay. Now, before 7th March 2025, for a period of 2 years, land or building of industrial undertaking should be used for industrial purposes. Should be used for industrial purposes by SSC. Then only exemption is available under 54D, otherwise exemption is not available. And this usage can be made either as a owner or as a tenant. See, mode of transfer by way of compulsory acquisition. Amount required to be reinvested is gross capital gain. Where reinvestment should be made? Reinvestment should be made in land or building of an industrial undertaking. What is time limit for reinvestment? Within 3 years from date of receipt of compensation. Very important. In case of compulsory acquisition, capital gains are not calculated in the year of transfer, but capital gains are calculated in the year in which a compensation is received. So let's say compulsory acquisition was done on 7th March 2025. Compensation received on 14th July 2025. The date on which compensation is received. From this date, within next 3 years, you have to purchase new land or building of an industrial undertaking. So time limit for reinvestment, don't calculate from date of transfer, don't calculate from here. It should be calculated from date of receipt of compensation. From here onwards, you need to calculate the time limit for reinvestment. Is it clear? Capital gains account scheme is available. Amount of exemption is gross capital gain or reinvestment, whichever is lower. Holding period, whatever the new land or building of industrial undertaking is there, that should not be transferred within a period of 3 years from the date of purchase or construction. Lock-in period is 3 years. Within these 3 years, if you transfer, then earlier exemption claimed will be reduced from cost of acquisition, just like section 54C. Next, whether capital gains account scheme is available? Yes, it is available, because 3 years time limit is there for reinvestment. So you can take the benefit of capital gains account scheme. But whatever the unutilized amount in capital gains account scheme is there, after expiry of time limit of 3 years, unutilized amount is again taxable as capital gains. Now let us discuss section 54EC. What is the combination under 54EC? Combination is immovable property to NHI bonds or RECL bonds or bonds issued by Power Finance Corporation, IRFC, Indian Railway Finance Corporation. Okay. So in these bonds, if you do reinvestments, that amount is eligible for exemption. So whenever you are selling land or building or any immovable property, whatever the capital gain amount that is received is there, if capital gain amount is reinvested in NHAI bonds or RECL bonds or Power Finance Corporation bonds or Indian Railway Finance Corporation bonds, then whatever the amount reinvested is there, such amount is eligible for exemption. So time limit for reinvestment is only 6 months. From date of transfer, within 6 months you need to do the reinvestment. As reinvestment is required to be made within 6 months, capital gains account scheme is not available when you are claiming exemption under section 54 EC. So you can see who can claim exemption under 54 EC. Any SSC can claim exemption under 54 EC. Capital asset required to be transferred is long-term capital asset. Capital asset required to be transferred is immovable property. Nature of such capital asset is long-term capital asset. And what is the where amount is required to be reinvested? Amount is required to be reinvested in NHAI bonds, RECL bonds or Power Finance Corporation bonds or Indian Railway Finance Corporation bonds. What is the amount that is required to be reinvested? Gross capital gain. Time limit is within 6 months from date of transfer. As time limit is very low, capital gains account scheme is not available. Amount of exemption is gross capital gain or reinvestment or 50 lakhs, whichever is lower. That means maximum exemption allowed under 54 EC is 50 lakhs. Let's say you purchased 80 lakhs worth of NHAI bonds. 80 lakhs is not allowed as exemption. Maximum exemption allowed is 50 lakhs. Lock-in period. Generally, lock-in period is 3 years for other sections. But for 54 EC, lock-in period is 5 years from the date on which you have purchased NHAI bonds. The date on which you have purchased NHAI bonds, from this date for next 5 years, they should not be transferred. Within next 5 years, if they are transferred means, see, consequence in case of transfer of bonds or conversion of bonds, or availing loan based on bonds as a security. That means you are keeping bond as a security and you are obtaining loan from the bank. That is also violation. Okay, so whenever you transfer bonds within 5 years, or whenever you convert bond within 5 years, or whenever you keep bond as a security and obtained loan within 5 years. So before then, exemption claimed earlier will be taxable as long-term capital gain in the year of violation. Let's say this year you have purchased NHAI bonds. Next year you sold NHAI bonds. That means within 5 years you are selling NHAI bonds. So next year, whatever the exemption that is claimed in current previous year is there, the same amount of exemption will be taxable in the next year. See, for 54, 54B, 54D, in case of violation, earlier exemption will be reduced from cost of acquisition. That concept is not applicable for 54 EC. For 54 EC, earlier exemption claimed will be reversed. Whatever the amount of exemption that is claimed earlier is there, that is reversed and taxable as capital gain in the year of violation. Is it clear? Good. So that's all about section 54 EC. Next, section 54F. This is similar to section 54. What is the combination under 54? Under 54, combination is residential house property to residential house property. Under 54F, combination is any capital asset other than residential house property to residential house property. This is the combination. Who can claim exemption under 54F? For example, I am selling gold. On sale of gold, I got capital gain. Okay. If net consideration on such a sale is reinvested in residential house property, I can claim exemption under section 54F. Is it clear? So any capital asset other than residential house property to residential house property. Amount required to be reinvested, very important, net consideration. For previous sections, amount required to be reinvested is gross capital gain. For section 54F, amount required to be reinvested is net consideration. Is it clear? And where reinvestment should be made? Reinvestment should be made only in one residential house property in India. I told you what is the combination. Any capital asset other than residential house property to residential house property. So reinvestment should be made in residential house property. Whatever the time limits for section 54 are there, same time limits are there for section 54F as well. Whether capital gains account scheme is available? Yes, capital gains account scheme is available. Amount of exemption, see, I have given. If reinvestment cost of new residential house is greater than net sale consideration of original asset, then entire capital gains is exempt. If cost of new residential house is less than net sale consideration of original asset, then only proportionate capital gains is exempt. What do you mean by this? How to calculate exemption under section 54F? There are two steps. Step 1, amount reinvested is equal to actual reinvestment or 10 crores whichever is lower. That means what? Whatever the amount that I have reinvested, total amount is not eligible for exemption. Amount reinvested or maximum amount 10 crores whichever is lower. Step 2, exemption under section 54F is equal to gross long-term capital gain into amount reinvested divided by net consideration. Let us do one problem, you will understand. Case 1. How much is net consideration? 15 crores. Long-term capital gain computed 7.5 crores. Reinvestment is 12 crores. Now what is step 1? Step 1 is equal to amount reinvested or 10 crores whichever is lower. How much is amount reinvested? 12 crores. 12 crores or 10 crores whichever is lower means step 1 is equal to 10 crores. Are you able to understand? Now what is step 2? Step 2 is equal to long-term capital gain into step 1 divided by net consideration. How much is long-term capital gain here? Long-term capital gain is 7.5 crores. 7.5 crores into how much is step 1? Step 1 is 10 crores. 10 crores divided by net consideration. How much is net consideration? 15 crores. So 7.5 into 10 by 15, how much? I think it is 5 crores. Let us see. Yes, 5 crores. So 5 crores is the exemption. Now did you understand how to calculate exemption under section 54F? Step 1, amount reinvested or 10 crores whichever is lower. Step 2 is equal to gross capital gain into step 1 divided by net consideration. Is it clear? Second one, amount reinvested is 15 crores. So 15 crores or 10 crores, whichever is lower means 10 crores. What is step 2? Step 2 is equal to gross capital gain 12 crores into how much is step 1? Step 1 is 10 crores divided by net consideration 20 crores. That means 6 crores is allowed as exemption. Is it clear? Let us do third one. For third one, how much is, what is step 1? Step 1 is actual reinvestment or 10 crores whichever is lower. So for step 3, how much is actual reinvestment? Actual reinvestment is 8 crores. So third one, step 1, actual reinvestment 8 crores or 10 crores whichever is lower means 8 crores. Step 2, exemption under section 54 is equal to 54F is equal to capital gain into step 1 divided by net consideration. How much is capital gain? Capital gain is 16 crores, correct? So 16 crores into step 1 8 crores divided by net consideration. How much is net consideration? I am sorry. Capital gain is 12 crores. I am sorry. It's not 16 crores, it is 12 crores. 12 crores into 8 crores divided by 16 crores. How much? I think it is 6 crores. 6 crores is the exemption under section 54F. Now did you understand how to calculate the exemption? Remaining 2 you solve on your own. Exemption under section 54F. It will be calculated in 2 steps. Step 1, actual reinvestment or 10 crores, whichever is lower. Step 2 is equal to capital gain into step 1 divided by net consideration. Is it clear? Next, lock-in period. Lock-in period is 3 years. That means new residential house property that is purchased, that should not be transferred within a period of 3 years. Sir, what is the consequence? Within lock-in period, within 3 years, if new residential house property is transferred, just like 54 EC, whatever the exemption that is claimed earlier is there, that will be reversed and it is taxable as capital gain. Is it clear? So under section 54F, within next 3 years, within lock-in period, if new residential house property is transferred, means proportionate capital gains which are claimed in earlier years, that will be reversed and it is taxable as capital gain. Is it clear? Whether capital gains account scheme is available, as capital gains account scheme is available. See, consequence if new house is transferred within, consequence where SSC, ఒక్క నిమిషం, you can see unutilized amount of capital gains account scheme. You deposited 40 lakhs in capital gains account scheme. After 3 years, only 30 lakhs is used and 10 lakhs is unutilized. With regard to this 10 lakhs, whatever the proportionate amount of exemption that you claimed in earlier years is there, that proportionate amount of exemption is taxable. So proportionate exemption claimed relating to unutilized deposit shall be taxable after the expiry of time limit. Is it clear? Now let us discuss section 112A or 111A. My dear students, only on transfer of 3 assets 112A or 111A gets attracted. What are those 3 assets? First, listed equity share. Second, units of equity oriented mutual fund. Third, units of business trust. On transfer of these 3 capital assets only 112A or 111A gets attracted. I sold building, I sold land, 112A will not get attracted, 111A will not get attracted. 112A, 111A gets attracted only on transfer of either listed share or units of equity oriented mutual fund or units of business trust. On transfer of any one of these 3 capital assets, section 112A or 111A gets attracted. Now conditions. With regard to equity share, securities transaction tax STT is required to be paid both at the time of purchase and at the time of transfer. With regard to units of equity oriented mutual fund and business trust, STT is required to be paid at the time of transfer. Only if STT is paid, then only 112A or 111A gets attracted. Are you able to understand? So eligible capital asset are listed equity shares or units of equity oriented mutual fund or units of business trust. These 3 capital assets, like STT is required to be paid, especially for equity share. STT is required to be paid both at the time of purchase as well as at the time of transfer. And for units of equity oriented mutual fund and business trust, STT is required to be paid at the time of transfer. So if asset is one of these eligible assets and conditions are satisfied, then we have to check period of holding. Based on period of holding, we have to take the decision. So if nature of capital asset is short-term capital asset, then section 111A gets attracted. If nature of capital asset is long-term capital asset, then section 112A gets attracted. Is it clear? You can check the period of holding. For listed equity share before 23rd July 2014, the criteria is 12 months. For equity oriented mutual fund, criteria is 12 months. For business trust, criteria is 36 months before 23rd July 2024. That means before 23rd July 2024, if unit of business trust is held for more than 36 months, then it is classified as long-term capital asset and 112A gets attracted. Is it clear? So on or after 23rd July 2024, for all these three capital assets, criteria is 12 months. If they are held for more than 12 months, classified as long-term capital asset. The thing is, please listen to the backstory. First April 2018 and 1st February 2018. See, in Finance Act 2018, what happened? Previously, on sale of equity shares, capital gains was not there. I mean, whatever the capital gain is there, total capital gain amount is exempt if you sell listed equity shares. So whatever the eligible assets that are there right now, units of equity oriented mutual fund, listed equity share, if they are sold before 1st April 2018, all these like listed equity share, units of equity oriented mutual fund, okay, whatever the gains are there, those gains are fully exempt under section 1038. There was no capital gain. That means what? Before 1st April 2018, if you sell listed equity shares, if you sell equity oriented mutual fund, there is no tax on their gains. However, in budget, in 2018-19 budget, on 1st February 2018, Finance Minister came up with the announcement that with effect from 1st April 2018, there will be tax on transfer of listed equity shares, and there will be tax on transfer of equity oriented mutual fund units and business trust units. Now, before 1st April 2018, there is no tax, right? On or after 1st April 2018, if you transfer listed equity shares or equity oriented mutual fund units or business trust units, from 1st April 2018 onwards, if you transfer these, like tax is there, and long-term capital gain under section 112A or short-term capital gain under section 111A is getting attracted. Very simple. Before 1st April 2018, whatever these eligible assets are there, if you transfer them, there is no tax. From 1st April 2018 onwards, if you transfer these eligible assets and STT is paid, then tax is getting attracted under section 112A or 111A. What happened? Those who purchased before 1st February 2018, they do not know, right, that there will be tax on transfer of listed equity shares. So that is why those who purchased shares before 1st February 2018 and sold their shares on or after 1st April 2018, for them special cost of acquisition is available. Is it clear? If above eligible capital assets are acquired before 1st February 2018, very important, and transferred on or after 1st April 2018, then special cost of acquisition is available in calculation of capital gains. Generally, what is cost of acquisition? Cost of acquisition is equal to purchase cost plus incidental expenses, and we will do indexed cost of acquisition. However, if these three eligible assets, listed equity shares, units of equity oriented mutual fund, business trust units, if these three capital assets are acquired before 1st February 2018 and transferred on or after 1st April 2018, then special cost of acquisition is available. What is the formula of special cost of acquisition? Full value of consideration or fair market value as on 31st January 2018, whichever is lower. Step 2, result of step 1 or actual cost, whichever is higher. Is it clear? Now, I will tell one example. With this example, you will get clarity. Listen. Listed equity shares. These were purchased for rupees 20 lakhs. Next, fair market value as on 31st January 2018, rupees 22 lakhs. And these are sold for rupees 25 lakhs. Calculate capital gains under section 112A if date of acquisition is before 1st February 2018, if date of acquisition is on or after 1st February 2018. See, only if date of acquisition is before 1st February 2018, then only special cost of acquisition is available. What is the provision? If date of acquisition is before 1st February 2018, then only exemption is, then only special cost of acquisition is available. Okay. So first let us solve this case, then we will solve this case. Case 1. So in case 1, how much is full value of consideration? It was sold for how much? It was sold for 25 lakhs. Full value of consideration is equal to 25 lakhs. My dear friends, please remember under section 112A or 111A, that gain whatever, indexation benefit is not available. For 112A and 111A, indexation benefit is not available. So from this, indexed cost of acquisition is not allowed as deduction. Only cost of acquisition will be allowed as deduction. How much is cost of acquisition? Cost of acquisition is 20 lakhs. But when these were purchased before 1st February 2018 and these were sold after 1st April 2018. When they are sold on or after 1st April 2018, 112A or 111A gets attracted. Correct? So, as these were purchased before 1st February 2018, special cost of acquisition is available. What is formula for special cost of acquisition? You can see formula is step 1, full value of consideration or fair market value as on 31st January 2018, whichever is lower. How much is full value of consideration? Full value of consideration is 25 lakhs. Fair market value as on 31st January. How much is fair market value? 22 lakhs. Whichever is lower means 22 lakhs. Step 2, result of step 1 or actual cost, whichever is higher. Result of step 1 is 22 lakhs. How much is actual cost? They are purchased for 20 lakhs. So actual cost is 20 lakhs. Whichever is higher means 22 lakhs. So cost of acquisition is 22 lakhs and capital gains are 3 lakhs. This is the scenario, first case. If date of acquisition is before 1st February 2018, then capital gains are 3 lakhs. Case 2. If date of acquisition is on or after 1st February 2018, then how much is full value of consideration? It was sold for 25 lakhs. If date of acquisition is on or after 1st February 2018, special cost of acquisition is not allowed as deduction. Only cost of acquisition will be allowed as deduction. How much is cost of acquisition? Cost of acquisition is 20 lakhs. Less cost of acquisition 20 lakhs. How much is capital gain? Capital gain is 5 lakhs. Now you will understand. 1st February 2018. How much is fair market value? 22 lakhs. Correct? How much is actual cost? 20 lakhs. How much is sale consideration? 25 lakhs. So how much is total gain? Total gain is 5 lakhs, right? Out of total gain of 5 lakhs, up to 1st February 2018, how much is gain? Gain is 2 lakhs. From 1st February 2018, how much is gain? Gain is 3 lakhs. So total gain is 5 lakhs, correct? Those who purchased listed equity shares before 1st February 2018, do they have any idea that finance minister is going to bring tax on listed equity shares and units of equity oriented mutual fund, they do not have any idea, right? So that's why what government did, up to 1st February 2018, whatever the gain is there, 2 lakh rupees, that was not taxed, and only balance gain of 3 lakhs was taxed. That's why if if date of purchase is before 1st February 2018, special cost of acquisition is allowed as deduction, and through special cost of acquisition only 3 lakhs was taxed. Now justice is done. Up to 1st February 2018, whatever the gain that is received by listed equity shareholders or units of equity oriented mutual fund unit holders are there, that gain was not taxed. After 1st February 2018, whatever the gain is there, only that gain was made taxable through special cost of acquisition. Is it clear? So that is the clear-cut understanding of the concept of 112A or 111A. So before 1st February 2018, if any person purchases those shares and transfer after 1st April 2018, capital gains gets attracted. But whatever the capital gain that is there up to 1st February 2018 is there, that capital gain is not taxable, and only capital gain after 1st February 2018 is there, only that was made taxable. Is it clear? Good. So this is all about section 112A and 111A. We will do problem. We will also discuss section 50AA. After discussing 50AA, then we will discuss this problem. Okay.